Bank of America issues a dire warning that the U.S. economy is about to face a recession shock. I'm your host, Steven Van Metre, and thanks for joining me today. And Bank of America is the latest of the banks to come out and warn Americans that the U.S. economy is in grave danger. And this at a time when most investors are mispositioning themselves as they usually do. And you're about to find out why they're wrong and what's about to happen. Let's head over where the story kicks off with Recession Shock. Bank of America is the latest major institution to deliver a grim warning for the future. It's been over a month since Russia invaded Ukraine, leading to an unforeseen and prolonged fallout for the global economy. Combined with an inflation problem that was already spiking the prices of virtually every commodity, global institutions have been ringing the alarm bells that we're on the brink of a long-anticipated recession. In an investment strategy report sent to clients on Thursday, Bank of America analysts warned that inflation always precedes recessions and that tighter monetary policies being put in place to control surging prices make a recession shock very likely. And while how accurate is their assessment? Well, it's spot on. Let's head over to the Federal Reserve database where we've got the Consumer Price Index on a year-over-year rate of change, and notably we can go back. Here's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and potentially now the 11th time we see a surge in consumer prices, as we see here the CPI on a year-over-year rate of change, leading to what those gray bars indicate are an upcoming recession. And as you can see, the recent surge in CPI is one of the fastest on record, indicating that the Bank of America analysts are dead on of what's going to happen here. Inflation has been a bane for the U.S. economy for months, and rates have hit new highs since the war began. The annual inflation rate jumped to 7.9 in February, the highest it's been in 4 decades, and the latest forecast suggests March's rates could reach 8.5%, if you can imagine, would be the highest since 1981. And higher interest rates have led to an inversion of the so-called yield curve, which is 10-year treasuries less 2-year treasury yields, meaning that short-term yields have suddenly become much more attractive than traditionally higher long-term ones. A surge in short-term yields is an indication that investors believe that the immediate future of the market is better than the long-term view, and that's something we've talked about before, that this is a big warning sign. And let's continue, because B of A analysts say this inversion is a sign that a recession is nigh. The yield curves always steepen as recessions begin, the report read, and B of A has joined a chorus of financial institutions warning about the likelihood of an immediate recession. Now, what are they referring to when the yield curve recession steepens? And then we'll go look at the chart, as they're referring to the fact that short-term yields will then start falling at a faster rate than long-term yields. And you know the consensus view right now is that rates are now in a secular rise, and they're only going to go higher, but the yield curve suggests otherwise. We're going to dig deeper into that, but let's see, is B of A right? Absolutely. You look back here in 1980, we got the yield curve inversion. You lead to a steepener, inversion, steepener, inversion, steepener, inversion, steepener. You've got it, another steepener, steepener, and notice the gray shaded bars, recession every single time. And here you can see 10-year treasury yields minus 2-year, and we're going to look at this. And now from a market perspective, because investors get this wrong every time. In fact, there's something that shouldn't be issued a dire warning for, and that's your portfolio during the next recession. Be sure to check out Portfolio Shield. Put a link up there in the corner in the description below, because I want to explain to you how investors get this wrong every single time. And yeah, you've heard that investors buy the most stocks at the top and then sell them at the bottom. And it may not make sense. Now, why do they do that? Why does this always happen? And the yield curve explains what's going on. So what's happening now is interest rates go up, bond prices go down. And so what do investors do? Yeah, they sell bonds. Now, they'll tell you they're long-term investors because maybe they're investing, 20, 30, 40-year period, but they're very short-term in what they're willing to hold, and they sell at the bottom. So you'll see investors who will either dump bonds or have a high allocation of their portfolio to bonds, and they will just exit the stage fast. Push the sell button, get out of that, and they'll run to equities. And now let's go back and start with this story of why investors get this wrong. Well, let's look what happens to bonds after an inversion. And here you can see I've overlaid the 30-year Treasury yield against the yield curve in blue. And what happens? You get an inversion. Well, there's actually two very close to each other. You see yields went down, went back up, yields went down. And here you see, and I want you to know, new all-time lows. So steepening curve after inversion, yields make new all-time lows. Steepening curve after inversion, new all-time lows. Steepening curve after inversion, new all-time lows. Steepening curve after inversion, new all-time lows. This time, everyone's saying it's different. But again, we come back to why do investors make these same mistakes? Because they don't understand how the markets work and they panic, they sell, and the right thing would have been to do is just to hang tight on those positions. But where do they go when they sell their bonds? You're right. They go to buy stocks because they perceive stocks, perceive them as a safety trade. Are they? Well, I'll let you be the judge. We'll start in this one, same chart with the yield curve in blue, but now I'm going to show you the Wilshire 5000, and I'm putting it on a year-over-year rate of change. And only because we're going back so far, you can't really see what happens during these inversions. But here you can see an inversion, year-over-year rate of change, boom, goes negative. And now you see a year-over-year, another inversion, year-over-year rate of change, goes down, turns negative. Another inversion, stocks go down. Another inversion, stocks go down. Inversion, stocks go down. Inversion, stocks go down. And this time, everyone, again, looking at the stock market as a safety trade. And so they start piling in toward the top. Now, this sometimes can cause the market to go on and make new highs for another 6 months, maybe even up to 24 months. But if the top's already in, but when the inversion's starting to happen, history says it's too late. But nevertheless, there's all selling bonds, which are likely, history says, to make new all-time highs, to buy equities, which are likely to go lower. Now, I know some of you are thinking, gold and commodities this time. Well, let's take a look and see what happens first off with gold. And what we see here is inversions led to a steep decline in gold here in the 1980s. We saw another inversion and led to a little bit lower gold prices. 2000s inversions led to higher ones. You see this inversion here, lower. The recession, which everyone says this time the gold prices will be immune to, well, that one went down, great financial crisis. And then the last inversion, we see gold prices went down again. But this time, everyone claims, well, that's different. So history's got, not quite a 50% hit rate, but it's a big bet that you're sitting on a 2000s rally in gold at this inversion. Of course, now you have the withdrawal of fiscal and monetary policy at unprecedented rates. It's a tough bet to make, but a lot of people, again, they look at their statements and they see stocks aren't going down that much. Gold isn't going down that much relative to bonds. I will sell bonds and buy those. And how about commodities such as energy? Well, let's take a look what happens to it after an inversion as well. And notably, after this inversion here, there wasn't really much activity going on. There was a brief spike, but prices really weren't, changed here in West Texas Intermediate. This is crude oil in red. Again, yield curve in blue. After this inversion, energy prices went down. You see this inversion here. There was a brief rise in energy prices before they came crashing down, and eventually they did. We see this inversion here led to lower energy prices, and this inversion here is likely to lead to, again, lower energy prices. And that's the story here, is it tells you financial conditions are tightening, and that's what the Fed is trying to do. They're trying to restrict aggregate demand, and so people end up running to what they perceive on their statements are the safety trade, and they end up selling the actual one they shouldn't have and buying the ones that they don't need more of. And it's all because they're truly not hanging on, not understanding what is actually likely to happen. And even the banks, as we look into the deeper data of the banks, we head over here to the H.8, the assets and liabilities of commercial banks. And now what are they doing? They're selling their mortgage-backed securities, and they're starting to buy treasury securities. Why? Because, the banks know what happened during the last financial crisis, and mortgage-backed securities weren't the place to be, and they had a ton of them in their balance sheet, and that was bad. Now we're starting to see them shed their mortgage-backed securities and buy those treasuries that people don't want, because they know it's coming and they don't want to be at the forefront of the next crisis. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.